Imagine throwing like the biggest party of your life.
Right.
Millions of people are cheering for you on live television. Confetti is falling. The bell rings.
Right.
But behind closed doors, your executive team is just sick to their stomachs.
Yeah.
Because you just left, tens of millions of dollars on the table in a matter of seconds.
Yeah.
And that is the reality of a quote-unquote successful IPO.
Yeah. The public sees a victory lap, but the internal perspective is often, well, it's a mix of relief and just intense financial whiplash.
Exactly. So welcome to this deep dive for our favorite learner. Today, we're tearing into an August 2026 Tech Reader magazine article called How an IPO Actually Works.
Mm-hmm.
The mission here is to deconstruct that exact illusion of the initial public offering. Okay, let's unpack this. The actual starting line is years before that opening bell.
Oh, yeah, way before. A company needs, 2 to 3 years of just pristine audited financials just to even enter the conversation.
Right.
But the most critical early move is bringing in the underwriters. And the mechanism here is what trips people up, I think.
Yeah, how does that actually work?
Well, the investment banks actually buy the entire block of shares from the company first.
Oh, wow.
Yeah, so they absorb the risk of the offering, and then they distribute those shares to their institutional clients.
So it's essentially hiring an insanely expensive real estate agent who, buys your house from you up front.
Yeah, exactly.
Takes on the risk that nobody else wants it, and then flips it to the neighborhood.
That is exactly it. And the premium for that risk transfer is steep. I mean, it's usually a 3 to 7% fee.
Wow.
Yeah, so on a $1 billion offering, the company is handing over $30 to $70 million right off the top.
Just staggering.
It is staggering, yet companies view it as a necessary insurance policy.
Right, because they need the connections.
Exactly. They're not just paying for risk absorption, they're buying the bank's Rolodex. They need access to the massive pension funds and hedge funds that can swallow a $1 billion stock issuance in a single afternoon.
But before those banks can actually go sell those shares to their clients, the SEC forces the company to, legally and mathematically justify its valuation.
Oh, yeah. The S-1 filing.
Yeah, anyone who follows the markets knows the S-1 is a regulatory requirement, but reading the risk factors section, it feels like flipping through a doomsday catalog.
It really does.
I mean, they are documenting every conceivable nightmare scenario, like macroeconomic collapse, aggressive litigation, a complete failure of their business model.
Yeah, it's a pure liability shield. The SEC doesn't care if the business is fundamentally terrible. They only care that the risk is transparent.
Right, so nobody can say they weren't warned.
Exactly. If a disaster materializes a year later and it wasn't explicitly warned about in the S-1, that's when the class action lawsuits start flying.
I'm trying to square this, though. You spend months drafting a legally binding manifesto detailing exactly how your company might implode.
Yeah.
And the very next week, you're embarking on a 2-week roadshow trying to convince top-tier hedge funds that you're the next tech giant.
Right.
How does anyone actually invest after reading that risk section?
Well, the institutional buyers know the S-1 is just legal armor. The roadshow is where the real narrative is tested.
Okay.
Though it is incredibly restrictive, executives cannot deviate from the S-1 text.
Wow, so they have to stick to the script.
Yes. But the underlying goal of the roadshow isn't to close a sale right then in the conference room.
Oh, it's not?
No. The banks are using these meetings to quietly gauge indications of interest and build a mathematical demand profile.
And that demand profile directly dictates the final price set the night before the opening bell, right?
Exactly.
Which brings us to the actual market debut. When the stock hits the public exchange and immediately skyrockets, the famous IPO pop.
Yes, the pop.
The financial networks treat it like a massive win.
Right, but what's fascinating here is that inside the corporate boardroom, a massive pop is seen as a catastrophic miscalculation.
Because the company already sold its shares to the underwriters at the lower price.
Yes, precisely.
So that 50% surge doesn't put an extra dime on the company's balance sheet.
Not a single dime. The banks actually intentionally engineer this underpricing.
Wait, really? Why would they do that?
By setting the initial price slightly below actual market demand, the underwriters guarantee a successful launch.
Okay.
And they minimize their own risk of getting stuck with unsold shares.
I see.
And crucially, they reward their best institutional clients with an immediate, risk-free profit on day one.
Unbelievable. So what does this all mean for the founders and the employees who actually built the company? I mean, they can't even participate in that first day trading frenzy.
No, they can't. The lockup period prevents that.
Right.
For 90 to 180 days, insiders are legally barred from selling.
Which makes sense, because if founders dumped their equity on day one, the sudden oversupply would crater the stock price, right?
Exactly. And it would signal zero confidence in the company's future. So they're essentially sidelined. They're just watching institutional clients trade their life's work while waiting for their own restrictions to lift.
Wow. And once that lockup finally expires, the grueling marathon they just ran turns into a permanent treadmill.
Yeah, that's a good way to put it.
Because the company is now trapped in a fishbowl. They're beholden to quarterly earnings cycles, activist investors, and just relentless public scrutiny.
It completely shifts the operational reality of the business. Survival is no longer just about building a good product.
Right, it's a totally different game now.
Yeah, it's about managing market expectations every 90 days.
Which leads you wondering about the future of this whole apparatus. With alternative avenues like direct listings and SPACs gaining traction in recent years to bypass this traditional, incredibly expensive process.
Yeah.
If the initial offering price and the public opening price are almost never the same, who is really benefiting the most from that engineered overnight price gap?
It's a great question.
Definitely something to think about. Until next time, learner.